Good morning. This is Mike Youngman from Ankerstar Wealth with Corey Hinkle, our newest team member. Steve is continuing to meet with clients this week, so we are doing the morning show just as the market opens. Today's topics, we are going to cover oil prices going up due to summer driving. Going to hit a little bit an article I saw on how to get the lowest mortgage rate, which is very important since rates are high. And then Corey's going to talk about the breadth of the market and what leads things higher and kind of where we stand with that. So, but before I get started, I must remind you this is a financial education presentation. You must do your own due diligence before acting on anything that you hear in this presentation. More disclaimer information can be found at ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So let me get started with, for those of you, and that tells you where I'm at, that drive a combustion engine car, and oil prices are going up. And yes, my wife does have a V8, so I do pay for oil and gas, or certainly gas. But we're seeing oil prices going up. I'm sharing on my screen for the second weekly gain as gasoline demand surges. And when I see that, obviously they're trying to make headlines and scare people and things like that. But I actually do like the part that says demand surges as opposed to supply is constrained. So, everyone knows that, prices are supply and demand. That's how they taught us that in basic economics. That means it is summertime. People are driving. The EV market has not taken over the world and eliminated all the combustion engines. And people continue to drive, even with the auto insurance rates through the roof. I remember years ago when I had a gas guzzler myself, and when I saw this kind of thing posted, I'd be like, I'm going to go up and fill up my car before the gas prices go up over the weekend. And maybe when you see this, you're thinking the same. So go fill that up. But crude oil up 3.6% this week. And this can be seen kind of as a good sign. And I used to wonder, why would that be good? That means the economy continues to move forward. Trucking costs, transportation, people moving, going on vacation, things like that. That's good. When everything hunkers down, then we're definitely in a recession, and we are not there. But I want to show the overall oil prices over the last, this is over many, many years. And if you could say, wow, if I just bought oil, well, yeah, I guess if you could buy a barrel of oil in 2000 and hold it, you'd have quadrupled or tripled your money. But you can see oil prices really since 2007, you can see a peak, and then really, the barrel of oil is, it's kind of flat, which is a good thing. That means that the world's supplying this as demand happens. And even now, they're saying oil prices are up. Well, they're really not up in the long term. Another question you might have is like, well, if oil prices are up, probably a good time to buy Exxon. Let's take a look at Exxon stock, and this is not anything that we hold in our model right now. But you can see this is a long-term graph here. I'll just look at like a 5-year graph, and you can see Exxon, hey, since that 2020 COVID crater when nobody was driving, so nobody was buying oil, and Exxon went down to like $25 a share. It's done well since then. It does pay a dividend, so it's a nice stock. Definitely not moving the way the tech stocks do, but a solid dividend stock. So cars are a big expense, but what is truly the biggest expense for most people? It's your house. And right now, many people, including myself, locked in our interest rate a couple years ago when things were low. Interest rates are high. If I had to go buy a house right now, I'm like, ugh, this is painful. So I saw this article in the Wall Street Journal today, how to get the lowest mortgage rate, and they talk about getting you to click. Yeah, I clicked on this. I wanted to see, how do you get the lowest mortgage rate? So I just thought I'd hit a couple of these suggestions. Number one, know your budget. And this is just key. Don't overspend. You don't want to get in a house bidding war that you end up buying a house and that you are cash poor. So you got to know that budget before. 2, have a good credit score, pay your bills. Unlike our government, don't get way behind. Here's a key one. Shop mortgage lenders. Now, the big banks aren't going to be happy with me saying this, but or insurance companies, you always want to shop and try different, compare your options and see what you can get. Even a quarter point on your interest rate is a big deal. You may think, oh, I negotiated 1,000 less in my house price, but a quarter point over, let's say, a 30-year mortgage is huge. So alternative mortgage options, you can look at an adjustable rate. Just beware. I mean, chances are the rates aren't going to go up any higher, but that's the danger. If you'd have bought an adjustable rate 3-4 years ago, you'd have been wishing you hadn't at this point. Mortgage points, don't know much about that. Usually I do not do that. Lock your rate. As soon as you know what you want, you can lock that rate in. Rates probably shouldn't be going up. So I don't know how critical that is. And then here's the biggest one I thought at the end. 7, take your time. So when you buy a house, this is a massive financial decision that it's hard to sell a house. Well, it's expensive to sell a house. It's probably easy right now, but take your time. Don't rush in. And once again, hey, let's look at Toll Brothers. So I just grabbed a house building stock that I knew of, and you can see that, guess what? This stock has went up just the way house prices are. So this is a 5-year graph. You can see in the COVID year, I mean, this thing was down to like $12 a share. I mean, it was way down, $13 a share that day. And now it's at 115. So you can see that, wow, boy, if I'd have just bought it that day, I'd have 10 times my money. But at that time, like, we thought no one was ever going to buy a house again, and we were just going to hunker down. So with that, hit real quick. The markets they're in a light red, a little bit down. But here's the thing I wanted to show. Ooh. So this is the last 2 days of Nvidia stock. It peaked at $140 a share yesterday. So yesterday morning, if you pulled the trigger and bought that thing at 140, right now you're down 10%. So 140 down to under 126. It's down 10%. And this is the danger. I mean, obviously, Nvidia, great company. We've covered a lot of it. Great company. So in a 10% move in 2 days does not mean that Nvidia did anything wrong, because I don't know of any news that would cause this, other than, it was really just that excitement to get them after the split. But you can see it's down some. Is this the time to buy? I'm not making that kind of decision, and it's continuing to go down. But of course, let's just look at a year to date. Obviously, it's just a little blip. It's doing fantastic this year. But when you buy things when everybody wants them, and I heard somebody say this yesterday to me, a darling stock, like everybody wants this thing. There's a danger when it falls out of favor just a little bit, it's going to drop fast. And so this is a good time to turn it over to Corey to talk about market breadth of, a few stocks driving things up. So with that, Corey, I'll stop sharing my screen and you are on.
Thanks, Mike. Yeah, we know we've had Nvidia, Apple, Google, and more of those big Mag 7 stocks driving us higher. Actually witnessing the market seeing new all-time highs even this week. Can you see that, Mike?
Yes, again.
Okay, now here what you're looking at is not some kindergarten artwork. This is an S&P 500 breadth chart. So we've got 3 lines, and let me just quickly explain each. So the black line, that one looks good. That's the S&P 500, new all-time highs this week. Next, look at that green line. Now, we're not going to look at any historical information here. We're really just looking at 2024. What do we see is that entering 2024, greater than 90%, you see that 90 on the right, greater than 90% of S&P 500 stocks were above their 50-day moving average. So that is a near-term relative strength for greater than 90% of S&P 500 stocks. Well, the market kept hitting new highs after that point, and the market is up quite a bit this year, around 15%. Or do you know specifically, Mike?
It was 15% yesterday.
So, I mean, what an amazing return just halfway through the year. Now, since that beginning of the year peak in relative, breadth in the market, we actually saw a drop off down all the way to 30%. So let's zoom into that green line here. This is that green line, and it shows you that in April, we got all the way below 30% of S&P 500 stocks above their 50-day moving average. Now that has started to expand a bit. Right now, we're currently just passing 50% of S&P 500 stocks above their 50-day moving average. And this breadth component, how many stocks are reaching relative new near-term highs, that does tell us a little bit about what's going on under the hood. So what does that mean for the S&P right now and possibly later this year? Well, we're already up a lot. And if the year ended now, it would be a great above average market return year for 2024. But when we look out there, we see that healthcare, some financials, software, lots of things in consumer discretionary and consumer cyclical, real estate, and even some of those industrials, they really package food as well. They really have not participated in this amazing year. So it's possible that this near-term weakness in market breadth could be setting the market up to push even higher for the remainder of the year. It's also true that possibly that near-term market breadth weakness that we've kind of been feeling the past month or two, it could be signaling that things are weakening, broadly weakening. We don't know for sure, but it's one thing that we watch to try to, be mindful of what's going on out there.
All right. Well, thank you, Corey. And I think that's really important to know that it's when Corey showed the graph where 30% of stocks were of the S&P 500 were over their 50-day moving average. That means just buying the S&P, that means 70% of your stocks, if you have the S&P, are below. Now, of course, it's a market cap weighted index. So that means you are definitely heavy in Apple, Microsoft, Nvidia, some big companies, and they are driving forward. And if you remember last year, the Mag 7, of course, everybody's like, oh yeah, I want Mag 7, was up 70-some%, where the market overall was up 24%, and everything else that wasn't Mag 7 was only up 8%. So we saw that come into this year, and the belief is that those earnings would spread out to the other 490 stocks that weren't like the top 10. And that's the battle we're seeing. Is it going to spread out to those other ones? Hopefully. Or is the Mag 7, Mag 10, whatever you want to, are they going to start to finally come back? Are we going to see Nvidia, and I think Nvidia will be a bellwether for whether we see this or not. Are we going to see them? How far might they drop? I mean, they're off 10% off yesterday's high. I mean, they could easily drop 20 or 30%. It's still a fantastic company. So I mean, don't like, oh my gosh, they need to fire their management or something. It's still a great company, but it's very, very expensive. It was priced to perfection. They had 2 perfect quarters in a row. So anyways, we'll see where this goes. It is Friday. Market's a little bit red. We will see you all next week. Thank you. Thank you, Court.